My company makes indicators to forecast market moves. This is not a good indicator. I can tell you that. It is not accurate. The level of data...
You mean the inverted yield curve?
Yes, exactly. Right. This yield measure of whether or not there's going to be...
Hasn't it predicted the last 7 recessions in the US or something? When you say it's not a good indicator?
7 out of... Do you know the amount of data you would need to crunch in order for something to be accurate? And by the way, when you say predicted... When? It wasn't the next day. In some cases, it was a couple of years later. Well, that's not helpful. It's like me saying, Sally, there's going to be a recession the next 2 years. Oh, you genius, Alpesh. No wonder they pay you the big bucks.
All right,
not only that, when it comes to the UK on the yield curve, it's been inverted, so predicting a recession, pretty much through most of the 1990s.
We're all on holiday.
I tell you what the smart way in which we forecast the markets is, like I said, we ride the coattails of the move. So we don't try and work out why did it happen. And the reasons you've mentioned are perfectly plausible. Newspaper headlines are perfectly plausible. We're not trying to see why it happened. Once it starts happening, we ride it. You might argue we exacerbate it by following on those trends. So
you make money from it.
Well, that's the point of being in finance.
And when you say you ride it, you're making money, surely.
Yeah, hopefully. That's
for your clients.
That's what should usually be the case. But in this case, and by the way, quite a few people didn't yesterday because, as you know, markets fell sharply, so quite a few weren't able to ride that, and they've lost quite a lot of money. But I think it's temporary, the good news. I don't think this is the start of a recession. I don't think it's a valid indicator of a recession, and given that we're less than about 5% off the market highs, which were around July, I think it's just a bit of people taking money off the table.